Hi everyone, my name is Ashutosh Gar. I've started this YouTube channel to post videos relating to US taxation. So without any further delay, let's start the video. Today's video is about schedules of Form 1120. Form 1120 is the one which is used by corporations to file their income tax return. There are three schedules which are L, M1 and M2. The schedules L, M1 and M2 are not required to be completed by corporations with total receipts and assets of less than $250,000. All other corporations must complete them. In today's video, we will discuss Schedule M1 in detail. Before getting into Schedule M1, just let's understand the background. Taxpayers have different aims when assembling the financial statements and the tax return. It is created with a focus on raising income for the benefits of shareholders while observing accounting standards. On contrary, the tax return is put together in order to lower taxable earnings and diminishing tax payments, although still adhering to tax regulations. This misalignment between the book income and taxable income stems from this distinct objective, which is Schedule M1, which basically reconciles a corporation's book income with its tax return income. M1 adjustments falls into four general categories. First, income subject to tax but not recorded in the books this year. Expenses recorded in the books this year but not deducted on this return. Income recorded in the books this year but not included on this return. The fourth one is deductions on the tax return but not charged against book income this year. This is how the summary of table M1 of form 1120 looks like. Is basically there are items which has to be added to the net income or loss per books, and there are some items which has to be reduced from it. So basically M1 adjustments can be divided into two categories. M1 adjustment that increases book income and the other one is which reduces book income. So let's understand the adjustments that leads to increase the book income. The first one is federal income tax. As shown in the corporation's profit and loss statement, Schedule M1 begins with the net income per books after subtracting income tax expenses. The amount has to be added back, which includes both current and deferred taxes. The second element is net capital loss. Since capital losses can be deducted in the books, this represents a timing difference. Under IRC section 1211, capital losses can only be deducted to the extent of capital gains. For tax purposes, excess capital losses can be carried back for 3 years and forward for 5 years. For book purposes, losses are not limited. The third element is income on tax return not included in books. These are the items that because of timing or other generally accepted accounting provisions have either been previously reposted, been used to reduce a balance sheet item, will be reposted in some subsequent period. The perfect example is like gain recognized in subsequent years on an installment sale, prepaid rental income, tax gain in excess of book gain on sale or disposal of assets. The fourth element is expenses on books not included in tax return. A variety of differences are included in this category, both permanent and temporary. There are expenses that cannot be deducted for tax purpose or are temporarily deferred until a future event occurs. These expenses reduce book income but do not affect taxable income. Some of the common items or examples like fines and penalties, political contributions, 50% of business meals, 100% of entertainment expenses, book depreciation exceeding the amount allowed for tax, charitable contributions in excess of the 10% of the taxable income limitations. So these are basically the adjustments that increases book income. Federal income tax, net capital losses, income and tax return not included in books, expenses on books not included in tax return. The second category is adjustment that reduces book income. So basically, these are the items that has to be subtracted from book income on Schedule M1. The first element is income on books not included in tax return. The book may reflect current income for financial reporting but defer the item for tax purposes. The category also includes financial income not subject to tax. Example, tax exempt interest on municipal bonds. Officers' life insurance process. Since the premiums are not deductible, income from the policy is exempt from tax. The second element is deductions and tax return not included in books. This includes all deductions claimed for tax purposes that are not recorded in the organizations. Best example is depreciation. Depreciation is the most common example since tax depreciation often exceeds the amount allowed for tax. Generally, taxpayers are allowed to use accelerated depreciation for tax purposes while using the straight line method for book purposes. So the adjustment that reduces book income are income on books not included in tax return, and the other is deductions on tax returns not included in books. In the subsequent video, we will discuss Schedule M2. Thank you.